Dobar dan svima. Jel možemo da počnemo? Dame I gospodo, predstavnici medija,
ladies and gentlemen, esteemed members of the press and fellow economists, welcome to the presentation of the Annual Financial Stability Report for 2015. If we call last year's presentation of this report history, or our firstborn, then today's press conference can be regarded as the start of tradition and continuation of good international practice. Macroprudential policy, or the policy of safeguarding financial stability, has been the focus of almost all economic discussions since the outbreak of the global financial crisis. The National Bank of Serbia does not lag behind other central banks in this respect. Quite to the contrary, we are keeping up with them. The depth of our analysis and the expert approach place us among the most efficient central banks in terms of achieving the financial stability mandate. We have been witnesses to turbulences in the international environment for quite some time already. The ripple effects of these turbulences did not bypass Serbia as an open and small economy. However, we did not stand by and wring our hands, waiting to be hit by the waves of uncertainty from different continents. In coordination with the government of the Republic of Serbia, we responded with timely action, carefully assessing the intensity of all influences. Through synchronization of monetary easing and consistent fiscal consolidation, we have maintained price stability, reduced external and internal imbalances significantly, and improved further the conditions for sustainable economic growth. As a result, the key policy rate is at its historical low since the introduction of the inflation targeting regime, and the fiscal deficit is at its lowest level since 2008. I will take the liberty of saying that the monetary policy easing of the National Bank of Serbia has paved the way for a sharp drop in interest rates on dinar loans in the last 3 years. To put this into numbers, from May 2013 until today, the key policy rate was cut 17 times by a total of 7.75 percentage points to 4%. That the interest rate channel is working in the dinar segment of the market is confirmed by the concurrent decline in interest rates on dinar loans to households and corporates by almost 10 percentage points to the lowest levels on record. Interest rates on government dinar securities also declined. Since November 2014, we have also reduced the FX required reserve ratios by a total of 9 percentage points, with a view to unlocking the credit potential of banks. Lower costs of borrowing and the funds released as a result of reduced FX required reserves, together with a pickup in economic activity, supported the recovery in lending activity in the second half of 2015, and we all know that lending is an important prerequisite for a sound financial system. There is no particular need to underscore that in euroized economies such as ours, the relative stability of the exchange rate and increased use of the national currency are the cornerstone of financial stability. The implementation of the dinarization strategy therefore remains one of our priorities. It is exactly in the area of macroeconomic stability, which represents the first and most important pillar of the strategy, that we have achieved significant results. Household dinar savings are now around 3 times higher than at end 2012. More than 2/3 of new household loans in 2015 were in dinars, while the figure is even higher this year, over 70%. We are pleased to see that the results of the National Bank of Serbia, which include low inflation, relative stability of the exchange rate, and the sharp fall in interest rates in the dinar market, have kick-started the process of dinarization. The commitment and effectiveness of the National Bank of Serbia in maintaining financial stability is reflected also in easing the pressures from strong international turbulences and averting them from our financial market. You will allow me, once again, to step out of the time frame covered by the report presented today and to touch upon the present. This is a way to show that time has not stopped and that we are discussing and monitoring stability all the time without limiting ourselves to the span of 1 year. After persistent pressures in the foreign exchange market late last year and in the first half of 2016, it took another huge shock, such as Brexit, to clearly demonstrate to everyone the importance of the National Bank of Serbia, its commitment, role, and contribution to stability. The National Bank of Serbia, with the huge support of the government of the Republic of Serbia, the Prime Minister primarily, took a proactive, efficient, and impartial approach. The quality of our presence in the market improved. Our interventions became more efficient. Our communication with all market participants enhanced, as did our coordination with the government. International portfolio investors confident in the central bank and the government, that is, confident in financial and political stability, show that they are prepared to make long-term investments in dinar government securities. And just what amount of FX reserves was spent in 2015 and 2016 to preserve this stability? In those 19 months, the dinar weakened by 2%, while in cumulative terms, foreign exchange interventions drove up the level of foreign exchange reserves by 25 million euros. We managed to do this by intervening in the foreign exchange market proactively, cost-efficiently, and effectively, I dare say, with filigree precision. You will hear from my colleagues today that our banking sector has remained stable and resilient to shocks from the international and domestic environment, despite the numerous challenges it faced. The results of macroprudential stress tests we carry out on a quarterly basis confirm that the banking sector remains well capitalized and highly liquid, even in the case of extremely pessimistic assumptions which did not materialize even at the height of the global financial crisis. High capital adequacy of the Serbian banking sector was reaffirmed by the special diagnostic studies of the quality of bank assets in Serbia. It gives me great pleasure to repeat once again that no capital shortfall was identified in any of the 14 in-scope banks, which account for 88% of banking sector assets. Still, like in most regional peers, resolving the high level of NPLs remains a priority. For this reason, the National Bank of Serbia took an active part in developing a comprehensive strategy for NPL resolution and adopted an action plan for the implementation of that strategy. The first results are already visible, as the share of non-performing loans in total loans decreased during the first 5 months of the year by 1.3 percentage points to 20.3%. Let me remind you that during this year's ministerial dialogue, the European Commission and the European Central Bank commended the systematic and comprehensive approach of the MBS and the Serbian government to NPL resolution and recommended the implementation of our NPL resolution process to other candidate countries. Ladies and gentlemen, members of the press, dear colleagues, the policies pursued by central banks nowadays and 10 years ago are not the same. They change and adjust to market conditions, specificities of local economies, capital flows, but almost invariably they have the same goal, to maintain stability, both price and financial. Confucius said, "The superior man is modest in his speech, but exceeds in his actions." This is our goal as well. We will therefore let others speak about us, those others being unbiased appraisers, such as the European Central Bank, the European Commission, the International Monetary Fund. And yet, we will not let their praises lull us into a false sense of security, but will, as so far, remain vigilant and ready to take proactive measures and preserve the stability achieved. Thank you for your attention. I now give the floor to Vice Governor Dijana Dragutinović.
Ladies and gentlemen, dear colleagues, friends and members of the press, welcome to today's press conference, where we will present our annual financial stability report. Exactly 1 year ago, at a very sensitive time, before special diagnostic studies were completed, and in the midst of the Greek crisis, we held the first public presentation of our financial stability report. At that time, we not only provided an assessment of the situation in the financial system, but also made an estimate of its resilience over a 1-year time horizon under conditions of stress. Today, we have the same task, difficult task, set in a very complex international environment. And though our last year's assessments were proven correct, we said at the time that the overall system was stable and that Greek-owned banks were resilient to large shocks. It is a rather challenging task to communicate to the public the extent to which we have fulfilled our objective of preserving and strengthening the stability of the financial system. Although there are many measurement tools which I mentioned last year, and which we presented in our report as simply as possible, financial stability cannot be quantified in the way that a monetary policy objective can, nor is it possible to disclose publicly data on individual financial institutions in the way that we can publish data on movements in different product prices. This is why it is difficult for the public, and when I say public, I mean a professional community, to fully appreciate the progress made towards financial stability. The role of central banks has changed globally relative to the pre-crisis period. Their scope of competence has widened, mostly in the area of financial stability, though the hierarchy of objectives has been retained with price stability as the first and foremost. At the same time, 8 years of financial crisis have weighed heavily on the conduct of monetary policy. It is common knowledge that the effectiveness of monetary policy diminishes in the conditions of low interest rates and high public and private sector debts. For this reason, non-conventional instruments such as quantitative easing are becoming something of a standard, but only in those countries whose key policy rates reached zero level, while central banks, which before the crisis boasted fully flexible exchange rate regimes, are now resorting even to foreign exchange market interventions. Similarly, as that of other central banks, the National Bank of Serbia's scope of competence in the area of financial stability has increased. Note that the National Bank of Serbia has traditionally held competences in this area. The supervision of financial institutions has always been within the National Bank of Serbia's remit. Also, the National Bank of Serbia has always had the possibility to perform the lender of last resort function by approving collateralized liquidity loans to banks facing temporary difficulties in maintaining liquidity. but which are solvent. New competencies in the area of financial stability mean that the National Bank of Serbia is responsible for the overall last resort policy through incorporation of the Bank Recovery and Resolution Directive into our regulations. Without denying the significance of bank recovery and resolution instruments, the primary objective of the National Bank of Serbia as banking system regulator and supervisor is to prevent banks from becoming distressed. And whereas it is true that a so-called orderly exit of a bank from a market without the spending of taxpayers' money is certainly better than a disorderly one, which is the whole purpose of the European directive, the best approach is the one that ensures prevention of a distress situation or a new crisis. For this reason, the National Bank of Serbia's remit in the area of financial stability has been extended to include responsibility for identifying and assessing systemic risk and the conduct of macroprudential policy. The new international regulatory package, Capital Requirements Regulation, Capital Requirements Directive of the EU, has set up prudential standards for credit institutions and investment firms in the EU. It became effective in January, on January the 1st, 2014, and its full implementation will start on the 1st of January 2019. This framework introduces new instruments to prevent a new crisis from occurring. And these are counter-cyclical capital buffer for systemically important institutions, and systemic risk buffer, as well as measures to control leverage, liquidity, and large exposures. In accordance with the new international regulatory package, in March 2015, the National Bank of Serbia made it known to the public that it would have the same instruments at its disposal and that they would be used to preserve and strengthen financial stability. When deciding on monetary policy measures and the return of inflation within the target tolerance band, the National Bank of Serbia must take into consideration other economic factors as well, including in particular external stability and the stability of the financial system. Ignoring the impact of monetary policy on financial stability could come at a high price, given the specific economic conditions and characteristics of our economy. By contrast to large economies and monetary areas, Serbia is a small and open economy. This means that the share of imports and exports in GDP is high, reflecting the country's high dependence on international flows of goods and capital. At the same time, being a small country, Serbia has no influence whatsoever over these flows or over the way global prices are formed. For Serbia, these prices remain as set. As a small economy, it can borrow abroad in foreign currency only. However, the high level of euroization in our economy further limits the pursuit of monetary policy, of the pursuit of an orthodox monetary policy. As you know, the high level of depositorization can be associated with a long history of macroeconomic instability in the course of final 3 decades of the last century. The high degree of credit eurization comes only as a consequence of deposit eurization. In such circumstances, which differ greatly from the conditions prevailing in large countries and large monetary areas, depreciation raises the level of debt and has a recessionary effect instead of having an expansionary effect on a rise in production due to the impact of increased demand for domestic goods at home and abroad. By trimming its key policy rate, the National Bank of Serbia triggered a decline in the cost of borrowing in dinas. At the same time, by maintaining exchange rate stability and keeping its foreign exchange reserves at an adequate level, the National Bank of Serbia has stabilized the repayment burden for those who borrow abroad and in the domestic market subject to a euro currency clause, thus contributing to the achievement of financial stability, which is within its remit as defined by the law on the National Bank of Serbia. This is confirmed by the fact that after rising for 8 years, non-performing loans remained unchanged in nominal DINO terms in 2015 relative to 2014. As a result of a stable exchange rate, fewer new non-performing loans were generated. Additionally, regulatory measures of the National Bank of Serbia encouraged banks to ensure increased coverage of NPLs with IFRS provisions and faster cleanup of NPLs from balance sheets of banks through increased loan write-off or selling to other legal persons. Positive trends continued into 2016 as well. In the first 5 months, non-performing loans decreased in nominal terms by 23 billion dinars, while the NPL ratio fell to 20.3%, by more than 1 percentage point. Ladies and gentlemen, dear colleagues, friends and members of the press, I now give the floor to the General Manager of the Financial Stability Department to explain in more detail our assessment of the progress achieved in the area of financial stability. Thank you for your attention.
Ladies and gentlemen, esteemed members of the press, dear colleagues, welcome to the presentation of the Annual Financial Stability Report for 2015. We will briefly touch upon the condition and developments in the financial system and present key risks and measures to mitigate those risks. Traditionally, this report covers the main segments of the financial system, such as the international and domestic environment, the segment of financial intermediaries, and financial infrastructure, and financial markets. The report also presents the results of macroprudential stress tests at the level of the banking sector with data as at the 31st of December 2015. At the very end of the report, a comprehensive assessment of financial stability is given based on analytical tools and methods that enable us to make not only an assessment of financial stability, but also to quantify the level of systemic risk. Additionally, the report contains a larger number of text boxes covering some of the most topical issues concerning financial stability during 2015 and in early 2016. Here we present the key risks from international environment and the measures to mitigate those risks. The slowing of economic growth of developed economies and developing economies, notably China, as well as the crisis in the euro area, the drop in primary commodity prices and the Fed's decision to normalize its monetary policy are the key risks from the international environment that marked 2015. The divergence of monetary policy of the Fed from the monetary policies of other leading central banks could lead to a tightening in global financial conditions, especially in some emerging market economies, where we may even expect a drop in capital inflows. Given the high share of banks in foreign ownership in the domestic market, developments in the euro area and movements in lending activity may, to a certain degree, affect the financing of subsidiaries in Serbia. Still, based on the results of the European Investment Bank survey on bank lending activity in the region of Central and Southeast Europe, there is a noticeable decrease in the risk of deleveraging in the banking sectors of these countries. Also, after a period of near-zero interest rate policies of leading central banks, in the medium term we can expect these interest rates to rise, which in conditions of volatile interest rates may lead to a rise in the cost of borrowing and the servicing of existing loans. One of the key risks is the high level of euroization of the domestic financial system. Around 70% of receivables from corporates and households and around 75% of deposits is denominated in foreign currency. Given that the currency structure of assets and liabilities of banks is aligned and matched, banks are not exposed to foreign exchange risk to a significant degree. On the other hand, the fact that a large number of clients have debt in foreign currency and receive their income in dinar makes these clients exposed to foreign exchange risks, and this also makes banks exposed to credit risk. Also, the high level of euroization weakens the transmission mechanism of the monetary policy and limits the impact of the key policy rate only on a part of the domestic credit market. Another risk, often debated in recent times, is the high level of non-performing loans and the relating low credit activity. The high level of non-performing loans at the same time represents a systemic risk to the financial system and a micro risk for individual institutions. NPLs are not a problem for the financial system only, but also a problem for the real sector, as they lead to a tightening in credit standards of banks and thus affect economic growth. Like we said, poorer prospects for the global economic growth, the drop in primary commodity prices, and the Fed's decision to normalize monetary policy are the key risks from the international environment. Based on the projections of the International Monetary Fund from April 2016, we expect moderate growth in the euro area of 1.5% in 2016 and 1.6% in 2017. In light of Brexit, the IMF has revised downward the euro area growth rate in 2017 to 1.4%. During the year, euro area inflation continued to revolve around zero. Responding to low inflationary pressures and weaker economic growth, the ECB made a decision in December 2015 to extend the program of quantitative easing. Such a reaction of the ECB has contributed to the easing of the possible effects of the normalization of the Fed's monetary policy on emerging markets, Serbia included. If we compare the vulnerability of the domestic system relative to 2014, we may say that this vulnerability decreased due to the reduction in external imbalances. What worked in the other direction was the continued rise in Serbia's public debt and unfavorable currency structure. Still, during 2015, there has been a considerable decrease in the fiscal deficit from 6.6% in December 2014 to 3.7% at end 2015 as a result of fiscal consolidation. After GDP dropped in 2014, in 2015, economic activity recovered. This growth was led by a robust growth in investment and net exports. In 2016, we expect economic growth to accelerate further to 2.3 or 2.5%, led by further rise in investment and faster recovery of personal consumption. Low inflationary pressures continued during 2015, and inflation was low and stable throughout the year. The year 2015 was marked by the relative stability of the exchange rate. Over the major part of the year, there were appreciation pressures, while by the end of the year, factors from the international environment, notably the crisis in Greece and the normalization of the monetary policy of the Fed, worked in the opposite direction. The key policy rate was lowered in 2015 by a total of 3.5 percentage points to 4.5%. By lowering the reserve required ratios, we have unlocked a part of the credit potential of banks, and due to this, we can expect a rise in credit activity. The interest rate Bionia continued moving below the key policy rate during the major part of the year. Stable macroeconomic situation, the lowering of the key policy rate, relatively stable exchange rate, and low inflation have led to a fall in Serbia's risk premium and to an improvement in the country's credit rating. This enabled lowering of interest rates on government securities and the cost of borrowing for the government. Owing to the effects of monetary policy easing, the cost of borrowing for the corporate sector decreased. At end 2015, average interest rate on new dinar loans equaled 6.2%, which is a decrease by 4.7 percentage points relative to 2014. In the same period, average interest rates on new euro-indexed loans were reduced from 4.9% to 4.2% due to the fall in Euribor. Interest rates on dinar and euro-indexed loans to households are at their lowest levels on record. The drop in dinar interest rates are a result of monetary policy easing, but also of increased competition among banks in the credit market. Interest rates on new dinar loans fell by 4.8 percentage points to 12.1%. In the same period, interest rates on new euro-indexed loans fell by 1 percentage point to 5.9%. The fall in interest rates and more favorable market conditions may, in the coming period, have a positive impact on credit activity and thus on economic growth. Serbia entered the crisis with a relatively high share of NPLs, which represents one of the main reasons behind the currently high level of NPLs. The upward trend in non-performing loans during and after the crisis does not differ much relative to other countries in the region. At end 2015, gross NPLs made up 21.6% of total loans. Observed by sector, the share of non-performing loans is still higher in the corporate sector than in the household sector. The share of non-performing loans is high, but it does not jeopardize financial stability, having in mind that these loans are fully covered by regulatory provisions and by IFRS provisions. Consistent implementation of the strategy for NPL resolution and the accompanying action plan of the National Bank of Serbia has contributed to the lowering of the share of NPLs from 23.2% in mid-2015 to 20.3% in May 2016. The banking sector recorded a positive financial result in 2015, despite a significant increase in expenditures in respect of indirect write-offs of loans due to the results of special diagnostic studies. Though profitability indicators are positive, they are somewhat lower relative to the regional average. The figures recorded in the first half of 2016 suggest a further recovery of the financial result of the banking sector. Despite the maturing of a larger number of subsidized loans in 2015, domestic corporate loans recorded real growth of 1.2% after 2 years of credit contraction. Credit risk of the corporate sector, measured as the share of non-performing loans at end 2015, equaled 21.7%, which is down by 2.9 percentage points relative to 2014. The reduction of the share of non-performing loans was aided by the recovery of domestic loans to corporates, as well as by the collection, write-off and assignment of a part of non-performing receivables. The sharpest drop in non-performing loans was recorded in the sectors of construction, trade and manufacturing. Owing to the recovery of economic activity, companies operated with a positive financial result in 2015 by contrast to 2014, when they operated with a loss. Return on equity in 2015 equaled 3.7% and was significantly higher in 2014 when it was minus 2.5%. All sectors operated with profit except for the sector of construction, where we have also recorded a significant improvement in its return on equity rate. As more than 90% of assets of the domestic financial system relates to the banking sector, developments in the banking sector are of paramount importance. The capital adequacy ratio equaled 20.9% in December 2015, and in March 2016 it stood at 21.5%, which is significantly above the regional average. Also, the capital adequacy ratio is significantly higher than the minimum regulatory capital capital prescribed by domestic regulations and by the Basel standard. The structure of regulatory capital is dominated by the best quality equity capital, which accounts for around 90%. Banking sector assets continue to be dominated by loans, which account for around 60% of assets. Also, cash and cash equivalents and deposits with central banks account for around 70% of total bank assets, which indicates high liquidity of the banking sector. Financial assets make up 18% of assets, and for the major part relate to the securities of the Republic of Serbia, which indicates banks' propensity towards safer investments. When talking about the sources of funding, banks in Serbia are increasingly reliant on domestic stable sources of financing. Total deposits at end 2015 made up 66% of liabilities, and the strengthening of the domestic deposit base enables banks to reduce their dependence on parent companies, which also reduces the exposure of banks to risks from the international environment. Stress tests represent an analytical tool which enables timely identification of timely warning of potential consequences in the event of extremely negative developments. It should be underlined that weaker results of stress tests do not necessarily mean that an individual bank, a group of banks, or the banking sector as a whole are facing problems, but they serve only to ensure timely assessment of the operations of banks in the event of less likely scenarios. Credit risk is the dominant risk in our banking system and accounts for more than 85% of total capital requirements. Based on macroeconomic scenarios presented in the report, we have projected a share of non-performing loans within the time horizon of 1 year. Based on the central projection, which assumes a mild growth in NPLs of 0.2 percentage points, capital adequacy ratio at the level of the banking sector would rise from the initial 20.9% to 21.3%. Under the moderate scenario, which assumes a rise in NPLs of 1.9 percentage points, capital adequacy ratio would fall to 18.3%, while in the worst-case scenario and an increase in NPLs of 3.8 percentage points, the capital adequacy ratio at the level of the banking sector would amount to 15%. This means that the capital adequacy ratio of the banking sector would stay above the regulatory minimum of 12%, even in conditions of the most unfavorable developments. The results of the latest round of stress tests based on data from March 2016 are even more favorable. The capital adequacy ratio, in the event of worst-case scenario, would amount to 15.8%, which indicates significant resilience of banks to credit risk. Liquidity risk is not that pronounced as the credit risk. Still, developments in October 2008, when around 10% of deposits were withdrawn from domestic banks, indicates the significance of monitoring this risk. For these purposes, we assume three scenarios. The first scenario is the déjà vu scenario of 2008, which implies withdrawal of around 10% of total deposits. The spillover scenario assumes deposit withdrawal of around 15% of total deposits, while the worst-case scenario assumes double the size of the shock that happened in October 2008, that is, withdrawal of around 21% of total deposits. The banking sector, even in the event of the worst-case scenario, would remain liquid with a liquidity ratio of 1.27, which is significantly above the regulatory minimum. We may conclude that even in conditions of the most unfavorable developments, our banking sector would remain well capitalized and highly liquid. A large number of initiatives has been launched at global level with a view to developing analytical tools to identify and measure systemic risk. For this reason, we have constructed such a tool that enables us to measure the level of systemic risk and to make a comprehensive assessment of financial stability of the Republic of Serbia. Based on this tool, we have identified stress periods. The period from January to December 2015 is marked by the period of low risk and low stress, with the exception of somewhat elevated level of stress in the beginning of the year in the segment of money markets and public finances. This relates to continued seasonal depreciation pressures from end 2014 and the high level of consolidated deficit. By mid-year, the level of stress also increased, mainly on account of turbulences in the international markets and the crisis in Greece. The period after June 2015 is marked by low stress. This period is marked by a relatively stable exchange rate and low and stable inflation. Low inflation in the environment and stable domestic macroeconomic environment enabled monetary policy easing in 2015. Also, we have seen a stabilization in the markets of neighboring countries. The domestic banking sector is well capitalized and highly liquid, which together contributed to the low level of systemic stress indicator in the second half of 2015. Finally, I will use the opportunity to invite you to have a look at the text boxes where we have discussed some of the most topical issues concerning financial stability during 2015 and early 2016. Thank you for your attention. We now open the floor for your questions, but please bear in mind that the topic of this press conference and this presentation is the financial stability function, and rather than individual financial institutions. Once again, thank you for your attention.
RTS, one question. Are we losing money on interest, which is negative, when we keep our foreign exchange reserves in AAA banks around 2.5 billion? And how much will Brexit cost us, as our foreign debt is predominantly in dollars and balance of payments in euros? And can you clarify about the strategy of NPLs? Because the Banking Association website says that the level is 16%, that banks sold many of their receivables. Here we see the figure of 20-point-something, so can you explain this difference? And what is exactly this strategy? Does it involve the write-off of evaluated tax on uncollectible receivables, etc.? So the write-off of tax. How did the strategy contribute to lowering the level of NPLs? Vladimir Petrovic, head of the Department for Macroprudential Supervision. I will clarify the question relating to the NPL strategy. The NPL strategy was adopted on 13 August last year, and on the basis of this strategy, we enacted two action plans. One is the action plan of the government of the Republic of Serbia, and another is the action plan of the National Bank of Serbia. These action plans envisage an entire spectrum of activities that need to be taken in order to implement these measures and in order to make sure that in the future period we see a reduction in the level, that is, in the share of NPLs in total loans. What has been done so far? Each of these two action plans contains certain deadlines and stages of implementation. When it comes to the action plan of the National Bank of Serbia, this action plan is at this point completely fulfilled, but that does not mean that the effects of this action plan are at this point that visible. They are already visible and evident, but these effects are only expected to be seen in future. When it comes to the action plan of the National Bank of Serbia, we implemented all our activities. We recently adopted amendment to the decision on risk management, then the decision on the classification of balance sheet assets and off-balance sheet items of banks. There we enabled new definitions of non-performing exposures, forborne exposures, etc. We will repeat now that from end August last year until May end May this year, the share of NPLs declined by 2 percentage points. So this is a very significant amount. And when we take into account the current share of NPLs, which is around 20%, we can come to a calculation that it will take 6.75 years in order to root out the NPLs completely in the Republic of Serbia. When it comes to Banking Association data, this is like some sort of refuse. You always have refuse in the production. So because it is impossible to have zero NPLs in the banking sector. So I was just saying hypothetically, if we continued at this rate of reduction of NPLs, this would happen hypothetically. The National Bank of Serbia late last year published guidelines on supervisory expectations relating to the manner of related to the application of International Accounting Standard 39 and impairments and provisions. Last year there was a large reduction in NPLs in the corporate sector by around 33 billion dinars. This trend continued this year as well. So at this point, the effects of our strategy are already evident, but it is only in the future period that we can expect to see the full effect. Let me now answer the question on Brexit and foreign exchange reserves. When it comes to foreign exchange reserves that the National Bank of Serbia holds and on which it earns, that is, minimizes the costs given the circumstances. First of all, I would like to share with you an interesting sentence. How the economists, sociologists will explain at a later date that money is not a goods on which you can make money, but on which you make losses. So the holding of money involves costs. So it is a reality to a degree, but not completely. The National Bank of Serbia believes that savings in Serbia should not be something that involves costs and not earnings. In the same way, large central banks are not threatening and are not announcing negative interest rates on the holding of foreign exchange reserves for all holders of money, whether it's in foreign currency cash or securities. So in a large Switzerland, which we all gladly look up to, only large holders of transaction deposits, government deposits, are warned of possible costs of holding money with the Central Bank of Switzerland. We, as the National Bank of Serbia, are facing the situation where in the past 7 or 8 years, where foreign exchange reserves, where we earned substantial revenue on foreign exchange reserves. Now we have the need to adjust our tactical guidelines, which are within the remit of the Executive Board, and which are adjusted to the strategic guidelines adopted by the Council of the National Bank of Serbia. And we adjust them so that we'll make sure that the structure of foreign exchange reserves in securities, transaction and time deposits is changed frequently. And within this structure, through currency and this other structure, whether these are securities or transaction or time deposits, we make sure that this structure is changed in order for us to move from the negative territory into the territory where we make earnings. So this is a big task, a very challenging task, and you can see very transparently from the National Bank of Serbia how much and whether we earn on a monthly level from the holding of securities. However, I would not like to leave the opportunity for another question, that whether foreign exchange reserves should be directed in another way because they do not earn enough? And I will say no to the question because by definition foreign exchange reserves are foreign exchange reserves and they are a buffer, a reserve. In Serbia they're at a high level. We ended with 10.3 billion euros, of which 18.5 tons of gold, around 7% of gold holdings in the foreign exchange reserves, and are mostly here. The rest of foreign exchange reserves serves for the purpose that it should serve, to ensure stability and to cover, not quarterly, but which is a minimum, here 6.6% coverage of exports with foreign exchange reserves in Serbia, of imports. They're serving their purpose. We are now discussing different creative ideas of how to put these foreign exchange reserves into function. But the law on the National Bank of Serbia gives us our mandate, and citizens should not be concerned because it is true that in turbulent times we maintain foreign exchange stability by foreign exchange interventions, but in 2015 and 2016, in very interesting capital movements when portfolio investors left the market and exited securities, we have managed to buffer this capital outflow with the least possible cost, which I like to call investment in financial stability, which cumulatively ends with plus 25. And I am particularly proud of myself and my team. And this is one of those non-conventional monetary policy measures, while other countries are able to finance their governments. Serbia does not do that and does not have the right to do that, and we do not complain of this. We are happy that the government is helping us with financial consolidation for us to do our job. But by being well informed on capital flows and all market participants willing to buy or sell foreign exchange, we have managed to end 2015 and this half of 2016 with plus 25 million euros in foreign exchange reserves. When it comes to Brexit, I will be short. We did not wait for Brexit to happen because we do not look at things passively. We take a proactive approach. We intervened a couple of days before in order to make sure that this herd psychology does not occur. And we managed, with a very small amount, to pacify the market and to show that we take good care of what is happening. For us, Brexit will only have the consequences it will have for our foreign trade and overall partners from the European Union. So to the extent that Brexit directly influences our foreign trade partners in the European Union and their growth, it will also influence us. So this will be in an indirect way, and also it will influence us through capital flows of portfolio investors who very quickly and easily enter the market through secondary trade in securities and who leave as easily. So it is our task to to make sure our financial stability is maintained in the face of all these headwinds. But direct connection with Brexit does not exist in Serbia because we do not have any banks that are directly related to that market. But we will look with great interest at further cash flows and the participation of Great Britain in all that. Of course, as through the we were able to weather the announcement of Brexit and the Greek crisis last year. You can see that for now we have been able to repair the possible bad impact of Brexit. I would also like to convince the public that the story about Italian banks is also a wish to peddle bad news and attract attention. Serbia has many banks headquartered in the European Union. Serbian banks are subsidiaries, but they are separate legal entities with subscribed equity capital. They operate according to our laws. And we have every right to convince you that we are closely monitoring and that it will take timely reaction to any problems relating to deleveraging, capital outflows, whatever. At this point, there is no reason for concern. The National Bank of Serbia is doing its job.
Savic from the Bloomberg Agency. The last thing we remember regarding the return of inflation within the target tolerance band was early 2017. Could you be a little bit more specific in which quarter of 2017 will inflation return within the target tolerance band? I'll be very brief. According to our projections, were like many others. We delayed the return of inflation within the target band because the factors affecting inflation are beyond our control. Oil prices, prices of primary agricultural commodities are very volatile, and they played a significant role in inflation departing from the projected path. Electricity prices were also not increased. In our last projection, we said that inflation would return within the target tolerance band in late 2016 and early 2017. However, we cannot be specific, we cannot be precise, because the prices of fresh meat are rumored to be increased. And if this happens, and if this becomes measurable and reflected in data that we receive from the Statistical Office of the Republic of Serbia. For instance, in retail stores where we envisage an increase in meat prices from 16.2 to 30%, depending on which retail store it is, or city, or producer, we expect that this increase will add to inflation from 0.32 percentage points to 0.56 percentage points. So from 0.32 percentage points to 0.56 percentage points. This means that our inflation projection, year-on-year inflation projection in July, would, instead of the 1.1%, equal 1.4% or 1.6% if these announcements materialize and reflect on inflation. So we expect inflation to return within the target tolerance band in late 2016 and early 2017. I would like to divert a bit from the topic of the conference. Did you participate in negotiations regarding the sale of Komercijalna Banka? Is it true that Societe Generale Banka is interested in buying that bank? I'll be very brief. The National Bank of Serbia does not participate in any negotiations, and I can tell you that this is something I have read also in newspapers, just like you. So I read in the newspapers that Societe Generale is interested in buying Komercijalna Banka. What the public needs to know is that the process of preparing for the privatization of Komercijalna Banka is underway, and the National Bank of Serbia, on its part, will support all market-based ways for consolidation of the banking sector, just as we always reiterated in our statements. All talks regarding the consolidation of the Greek banking sector in the Serbian territory must be held where they are supposed to be held, meaning not in the newspapers and not with a view to raising panic and causing damage to anyone. So this is the task of the National Bank of Serbia, to analyze this from the aspect of its competences and not to attach any sensationalist tones to these issues. If there are no further questions, yes, there is another one. Since we already diverted from the topic, could you tell us whether it will affect your work and stability, the anticipation of the new government? Not at all. I will be very direct in answering this question. In February, on the eve of elections and ahead of the elections, we lowered the key policy rate and narrowed the interest rate corridor. We are doing our job because not even then, just as we do not expect now, we did not expect at the time, and we do not expect now any change in the policy of the government that will be formed by Aleksandar Vučić. In our last meeting of the Executive Board, due to low inflationary pressures and overall circumstances, we lowered the key policy rate to 4% and also narrowed the interest rate corridor because we think that our monetary policy has reached a kind of equilibrium and a degree of normalization relative to the period of 3 or 4 years ago. And for us, the formation of the government of the Republic of Serbia really represents no factor of risk. The facts that confirm this are the interest of foreign investors in government securities of 7-year maturity, which sold out at a lower rate of 4.7 percentage points. And this overall political and financial stability is the reason for investment in government securities. Because in this way, international markets are showing confidence in the policy pursued by our authorities. Everything else is at the level of the levels recorded last year. Foreign direct investment of good quality, diversified and substantial. Remittances are somewhat lower relative to the previous year, but we expect it to stabilize at the level of 2.7 billion euros until the end of the year. And really, there's no piece of data that could confirm that the formation of the government brings any kind of risk to our work and stability. And what if the future government is not led by Mr. Vučić? I could answer this question using the sentence that Diana whispered to me, but I will tell you this. What if? There is a beautiful verse saying, "Weave, weave, weaver of the wind." We are a very conservative institution, serious institution. We deal with serious analysis and figures. And trust me, what you asked me is something that is in the domain of weaving the wind.
Svima. Zahvaljujem se na posjećenosti i vidimo se prvom sljedećom prilikom.